Hi everyone, welcome to another video on this channel. Today's video is not really about any particular mutual fund category or any particular mutual fund scheme or any other basic information about mutual funds and how they work. But rather the topic of today's video or today's discussion is valuable advice for mutual fund investors from Peter Lynch. Now, who is Peter Lynch and what is his advice? We will see. As you all know, my name is Paresh. I am an NISM certified and AMFI registered mutual fund distributor. My ARN number is 334516. On the right hand side, you will see a QR code. You can scan that QR code, download the Funds Bazaar app, and start investing in mutual funds or direct equity. Through that app, you can also purchase insurance, fixed deposits, and many other financial products through that app. Before we move ahead, this is a standard disclaimer. Although we are not really talking about any Indian mutual fund schemes or categories in this video in particular, I still think this disclaimer is important because mutual fund investments are subject to market risks and you need to read all scheme related documents carefully before investing. Past performance of any mutual fund scheme is no guarantee of its future performance. So, who is Peter Lynch? Right. Now, Peter Lynch is a legendary Wall Street fund manager. So just like in India, we have multiple mutual fund companies. In US also there are many mutual fund companies. Fidelity is one of them, and Fidelity had a fund called as the Magellan Fund, right? Which was investing in US companies. So just like Indian mutual funds typically invest in Indian companies, this is a American fund which was investing in American companies. Now Peter Lynch managed the Magellan Fund for 13 years, until his retirement at 46. So he became fund manager of Magellan Fund at the age of 33, one of the youngest fund managers in the history of Wall Street. The fund under his management, the fund earned an annualized return of 29.2% over 13 years. Now, an annualized return of 29.2% over 13 years is a fantastic experience, is a fantastic performance, right? There is no other fund manager in the world who has given this kind of returns. So Peter Lynch is a legendary. When I say he is a legendary fund manager, I'm not at all exaggerating. I'm not using this word casually, right? So, and just imagine, right? The benchmark of the fund was S&P 500, and the return which he generated over those 13 years were more than twice of its benchmark. Now, beating the benchmark or beating the index is in itself a very, very tough task. And any fund manager who does that even for a year probably pats themselves on their backs, rightly so. Even if they kind of outperform the index by 1% or 2%, like if, for example, if the index has written 13% and if the fund has written 14%, it is a good achievement. There is no doubt about it. But look at this achievement, right? 29.2% of annualized returns for 13 years, which was more than twice what the S&P 500, the index in America, returned or earned during that time, right? So he has written two books on investments, one upon Wall Street and Beating the Street. Whatever advice you will you will see in the following slides in this video are based on his writings in these two books. So the first very interesting framework that Peter Lynch has are the three C's of unsuccessful investors, right? So unwary investors pass in and out of these three emotional states: concern, complacency, and capitulation. So this is what Peter Lynch calls the three C's, and these are the three emotional states that you as an investor needs to be aware of and prevent the pitfalls that are present during each of these emotional states. So this is how he explains. Okay, an unsuccessful investor is first concerned. Okay, after the market has dropped or the economy has seemed to falter, which keeps them from buying good companies at bargain prices. Understand this, whenever the market falls, and if there is a crash by 10%, 15%, 20%, suddenly there is panic in the market. You will see newspaper headlines that so many thousand crores of investor wealth vanished. Index Sensex fell by 1,000 points, Nifty fell by 400 points, and all that stuff. You will see, so you will certainly see, on news channels, you will see all the red, because all the indices are flashing in red. Now remember, this is the time when you should actually be happy as an investor, because you are getting companies, whether you are buying direct shares or you are buying mutual fund units, you are getting them at a bargain price. Like every year, if you know, twice every year there is an annual sale of most departmental stores. That happens everywhere across the world, but in fact in India it is quite common. So I don't know which departmental store you shop at. So let's say West Side, okay, or Lifestyle, or Pantaloons. They will have these, 50% off sale, maybe twice a year, or buy one get one free, those kind of sales. So whenever a market crashes, right, or corrects by anything, say 10, 15, 20%, that is the equivalent of the sale that is going on in the share market. So as an investor, you should actually be, very happy that you are getting good companies at a cheap price. So that's what bad investors do. They become concerned, right, when the market has dropped. So the second mistake that they do is that when they buy at higher prices, they get complacent, right? Because they see the stock price rise higher. So when the market is in a bull phase, right, everyone is buying. This is the biggest folly, right? If you see, the money is actually made during bear markets, when the markets are falling, because that is when you are getting the companies at cheap prices, and when the market recovers, you have made the profit. But when the market is in bull phase, there is there is not much that you can do unless you get in the bull phase at a very early stage. So what happens is that when the market is rising, every time you see, which happened during last few years, that every time the Sensex or Nifty was setting a new record, you see those headlines that Sensex rises 1,000 points, Nifty rises 400 points. In a week, the Sensex has given 3%, 4% return. That is where investors flock into share market. They buy mutual funds and they get complacent about it, right? Because when they see the stock price, the prices keep on rising higher, the index keeps on getting higher and higher. In fact, this is the time that you as an investor need to be concerned and check the fundamentals. Is the rise in Sensex or is the rise in share prices justified? Is it backed by earnings? Is it backed by future growth, or is it just a hype that is going on, right? So that is the phrase. This is the phase where you need to be concerned, but bad investors are complacent. And finally, when the stock market crashes or the stock crashes to the prices below what they paid, they capitulate and sell. This is a typical cycle that every investor goes through this cycle, right? And bad investors do not learn from it, and they either completely exit the market or they make tremendous losses. Good investors also go through this. Even the best fund manager in the world, or even the best investor in the world, has gone through these cycles, and they have made the mistakes. The difference between good investor and a bad investor is that a good investor realizes the mistakes that they have made and they don't repeat it. So understand these three C's and identify whenever you are making a decision, whether you are buying a share or buying a mutual fund or thinking of redeeming a mutual fund or selling off a share. Are you falling into this 3C trap? Right? This is very important. And remember, this advice is typically for share, buying people who directly buy share, although some of it is still applicable for mutual funds. Now, why I'm saying this is that, in mutual funds, you should not typically look at doing profit booking, because the fund manager is already doing profit booking to a certain extent, right? Yes, if you are invested directly in a company's equity, let's say you have bought the shares of company X, and in a very short time the shares have jumped maybe 30-40%. Yes, you should think about booking the profits. But mutual funds do not really work like direct equity, right? Because the fund manager is taking the decision. Mutual funds, when you invest, you should typically have a longer investment horizon of, say, let's say, at least 5 to 6 years. Ideally, you should have a very long investment horizon. You will see why this is so in the coming slides. But remember this, understand these concern, complacency, and capitulation, and try your best to prevent falling into this trap. The second advice that Peter Lynch gives is importance of long-term orientation in equity markets. Right? What he says is that people who succeed in the stock market accept periodic losses. See, you're not going to make money on every trade or every investment that you make. Right? There is even the great or legendary investor like Warren Buffett. has not made money on every investment that he has made. He has lost money on some investment also, right? But overall, at a portfolio level, his returns have been phenomenal. Why? Because he has made less mistakes than many other investors. So this is what you need to understand, that periodically you will make losses, you will make wrong decisions, right? But it should not let you deter from being invested in the stock market, right? So calamitous drops do not scare them out of the game. The trick is not to trust your gut feelings, but to discipline yourself to ignore them. So when the markets are falling, every day you're seeing in the, I think in the last few months you're seeing this, the index, fluctuate quite a bit. It reached, I'm talking about the Sensex level. We are in August 2025 right now. So Sensex, I think a few months ago reached around 85,000. It dropped all the way back to 76, 75,000, and it is now fluctuating in between these levels, right? So as an investor, when you see these kind of drops, it is very basic emotion to kind of cut your losses, right? Or protect your capital. Let's say withdraw your money or redeem all your units, and let's wait for the market to probably reach bottom, and then we will invest again. This is not to be done in any mutual fund investments particularly, right? Invest in a company after you have done the homework on the company's earning prospects, financial condition, competitive position, plans for expansion, and so forth. Stand by your stock as long as the fundamental story behind it has not changed. Now this is an advice for somebody who is investing directly in stock markets, in the company shares, but you can still derive some important insights as a mutual fund investor. What are these? First is that do not check NAVs on a daily basis. Once you start investing in mutual funds, it is quite natural to see how your investment is growing, and especially when you are in a bull market, it becomes quite addictive, right? Because every day you are seeing, a day before I had a gain of 1% absolute, in terms of absolute. Today I have 1.1%, tomorrow I will have 1.2%. So it becomes quite addictive to see or watch your money growing, right? But do not get into that. Why? Because when the market starts falling, you also get into that kind of addiction, right? Because suddenly, you will see, say, an absolute gain of 10% become 8%, then it becomes 7% in a few days, then suddenly it becomes 2%, and then you are scared. What if it now slips into negative? And then you try to redeem your mutual fund units, and that kind of completely destroys the value, right? Because see, money in stock markets, whether you are investing in direct equity or whether you are investing through mutual funds, is always made over a long period. This is a consistent piece of advice that you will find from all legendary investors, right? Money in stock markets is always made over a long period, and that long period is typically 10 plus years, but at least you need to give 5 years to your investments. And especially when it comes to mutual fund investments, they are not to be touched unless you really are in a desperate need for money, right? So do not check your NAVs on a daily basis. During periods of bear markets, do not panic. That's exactly what I said. Suddenly you saw that, maybe during the bull phase, if you had invested 1 lakh, maybe you saw, you had a profit of 20,000, and suddenly it is dropping. That 20,000 profit became 10,000, 5,000, and suddenly it slipped into maybe minus 2,000, minus 3,000. So your 1 lakh rupees which you invested maybe a few months ago has now become 95,000, which means you are staring at a 5,000 loss. This is just a typical example I'm taking. This is not based in any actual index movements, right? So at that moment, your basic instinct is to just cut your losses. Okay, let me redeem this, so that right now I have 95,000. What if I wait for a few more days and it might go down to 80,000, right? Do not do that. Why? Because the moment you book losses in mutual funds, they are not coming back. You are not recovering from those losses. If you give it enough time, right, the market will eventually recover. It may take 2 months, 3 months, 6 months, even a year, but eventually the market will recover, and you will, over a period of time, make good returns if you have chosen the right schemes and done your homework before investing in those schemes. So that is my point. If you have chosen the right schemes after consulting with your mutual fund advisor and doing your homework, be patient and have a long term horizon. Do not let these short term fluctuations deter you from investing in mutual funds. And the worst thing that you can do when it comes to mutual funds is that redeem at a loss. That is something which must be avoided at any cost. because the moment you redeem at a loss, there is no way you're going to recover that loss, right? If you just keep your money in the market and just ignore all the noise in the short term, eventually most good schemes will recover and give you decent returns. Next important advice from is that do not play the market, right? What is playing the market? That you anticipate where the market is going, or suddenly, when somebody starts following the market, maybe for a few days they become experts on the market. They will say, okay, I expect the market will reach at this level by month end, and then I will redeem my stock. Or maybe the market will crash to this level and then I will put in my money. So this is what is typically called as playing the market, right? So what Peter Lynch says is that people who are no good at picking stocks are the very ones who say they are playing the market, right? So these are typically the overconfident investors. You will Some of them you might see on news channels, some of them you might see writing blogs or even creating videos, who think they can predict the market, where the markets are going, and they are so confident in their predictions. It's as if they have seen the future. Nobody can play the market, not even the legendary investors like Peter Lynch or Warren Buffett, right? So when you play the market, you're looking for instant gratification. What does it mean? That you're not really investing, you're just kind of gambling, right? It's like you're in a casino. You know the market is going up, so you put maybe 10,000 rupees today in a mutual fund or a stock, and then it goes up to 14,000, 15,000. You redeem it, you get that 4,000, 5,000 rupees profit, and that kind of gives you kick, right? Once you make some money in a short period of time, you tend to invest more. And instead of holding it for a long time, if you are looking to kind of the excitement that comes from the weekly gains that you make from short term trading, that is where you fall into the trap of playing the market, and that is where most individual investors or retail investors lose out, right? So playing the market is an incredibly damaging pastime. This is what Peter Lynch is saying. Players of the market may spend weeks planning a trip and hours studying their frequent flyer plans, but will turn around and invest $10,000 in a company they know nothing about. This is what most retail investors who don't know even the basics of financial markets or financial statements go about it. They read or they get tips from some random people that this is a hot stock, it is going to double in a few months, or they watch something on the news channels about a company which is perform whose stock price is breaking records, or hitting the upper circuits every now and then. And even without studying the company, even without studying its financials, they will put in maybe a lakh rupees into that company stock, right? And sometimes they make money, most of the times they end up losing the money, because nobody has been able to time the market, right? So this is sloppy and ill-conceived. This is Peter Lynch's words, right? More often than not, they are chronic losers with a history of playing their hunches, which means you're not really analyzing the company, you're not really doing the fundamental analysis of the company, whether the company is good or not. You are just kind of going with the momentum, just because last maybe 4 5 sessions the stock has hit upper circuit. You are throwing money at the stock and hoping that it will keep hitting upper circuit. Now hope is not a strategy, right? So in the end they are more convinced than ever that investing in stocks is a game, but that's because they have made it one. Look at the highlighted words. These are his words, these are not my words, right? And this is a fantastic explanation why people who lose money in the stock market, okay, most of them never come back to the market, but then they will go around and tell 100 other people saying that this is a scam, this is a fraud. You must have come across these people, right? The moment you talk to them about investing in mutual funds or even stock market, they are the first ones to say, don't do it, this is all a scam, it's fixed, it's rigged. It is not, right? Indian stock market today is a highly regulated stock market. There is SEBI, there is RBI. The amount of regulations that the Indian stock markets face, especially the mutual fund industry, there is no way it is a scam. I mean, even today, I keep hearing things from even well-educated people. Okay, people who are not were not from the financial background, but in other fields, who are well-educated, who still regard stock markets as some sort of a scam or some sort of a gamble or some sort of a casino where people only lose money. This is not true, and this is because either they or somebody else they know have lost money in this way, right? So Again, read the sentence again. In the end, they are more convinced than ever that investing in stocks is a game, but that's because they have made it one. Stock market is not gambling. Stock market is not a game. It is There is a mathematical logic behind why company prices increase. There is a formula to arrive at an approximate fair value of of a company share, right? So it is not a game. If you're looking at it from a long term perspective, it is not a game. It is basically a very intelligent decision making based on financial analysis and based on financial modeling, right? Very important advice. I suggest you pause the video at this point and read this entire slide again. These are his words, whatever are there in the black and white. The last column is mine. The last shaded box which you see in faint red is mine. So what does this mean for mutual fund investors? Do not try to time the market. Nobody in the history of investing has been able to do it successfully. What is timing the market? You must have heard from people, right? So for example, if you're a new mutual fund investor and today if you go and talk to somebody that I want to invest money in the market, should I invest? Somebody will say, based on the trend which is going on currently, just wait for a few days. I think the market is going to correct even more. Maybe just wait for a couple of weeks and then you can think. Do not do that, right? If you have money to invest in the market, it is better to put it. I'm not saying you put it from a lump sum. You start a sip. Let us say you have something as little as 5,000 rupees to invest, right? Today, let's say we are in August 12th, 2025 today, and let's say you have 5,000 rupees to invest in the market, and you are a new mutual fund investor. Now, if you go to some financial news, you read financial news or listen to financial news, listen to TV channels or talk to somebody else who is investing in the stock market, that person might advise you that the stock, the markets are falling. Let us wait for a few more weeks, and then maybe you can think of. This is not a sound advice, right? Because nobody knows what if the market from tomorrow the market just keeps going up, right? So then in a couple of weeks you would be entering the market at a much higher level than what the level of market is today, right? So nobody can predict the market. Timing the market is a futile exercise. Nobody has been able to do it. If you have money to invest, especially in mutual funds, I'm talking only about mutual fund investors right now. If you have money to invest, start a sip right away. Doesn't matter where the market is. you know you can start a monthly sip or even a weekly sip, depending on where you think the market is going to be. But do not wait for the market to correct. The market has always has the ability to surprise you, in both the directions. If you think the market is only going to keep going up, the market can surprise even the best of investors in the negative way. At the same time, the market can also surprise you in a positive way, right? There is a saying that time in the market beats timing the market. What does it mean? the if you have money to invest in the market, invest it right away. Not in lump sum manner. Start a sip, but start investing if you have investable money. Do not wait for the stars to align and some kundli and all stuff to align before you make that investment decision. The next advice is about equity as an asset class, right? Now, this is the first point is that Peter Lynch says the retirement account is the perfect place for stocks because money can sit there and grow for 10 to 30 years. Now, this is applicable in the case of American citizens because they have something called as a 401k, quite similar to what we have employees provident fund or even public provident fund. But over there, they invest in stock markets. Some portion of it goes to stock markets, and this is like a EPF or a PPF only. Okay, they have strict withdrawal limitations. You can Once you put in money, you cannot take it away, and that kind of gives some discipline, because once you put money into that, it can stay there for anywhere between 10 to 30 years without you being able to withdraw it, right? So if you hope to have more money tomorrow than you do today, you have to put a major chunk of your assets into stocks. If you have surplus money, okay, there are multiple avenues or asset classes in which you can park that money. There was a previous video on this channel about multi-asset funds, and those who have watched it will understand what an asset class is. But typically, the broad asset classes available in India are basically, equity as in mutual funds, or you can put it in a bank fixed deposit, or you can invest in bonds, and then there are multiple other options, right? But historically, right, equity has always given better return than any other asset class, including real estate, including gold. And this is true across the world. This is not just true in America, this is true in India also. And it has been proven with data, right? So sooner or later, what Peter Lynch says is that sooner or later, a portfolio of stocks or equity mutual funds will turn out to be a lot more valuable than a portfolio of bonds or debt or money market funds. What does that mean? That you have to invest in equity, pure equity funds. Mutual funds, as you know, there are multiple schemes, right? There are equity schemes, there are hybrid schemes, there are pure debt schemes, and obviously each scheme has its own role to play. uh, Nobody is saying that you should put all your money into pure equity funds. Obviously you need to diversify a bit, so you have to choose hybrid funds also, you have to choose pure debt funds also, or even liquid funds also, if you just want to park money for a year or so. But if your investment horizon is long and you really want to beat inflation and create wealth, there is no alternative to equity or pure equity mutual funds. You can choose a flexi cap fund, you can choose a multi cap fund, you can choose an ELSS, you can choose even a multi asset allocation fund, but it is not, although it is not pure equity. But make sure that you have a meaningful exposure to equity in your savings plan. Don't just put your money in a fixed deposit and forget about it, because fixed deposits are not giving the kind of returns that would help you maintain the current lifestyle in future, right? Most of the cases, after tax adjustments, fixed deposits are actually giving negative returns, inflation adjusted returns in India, right? So what does that mean for mutual fund investors? If you read the above advice, is that start investing early, have a long-term horizon, 20 plus years, and predominantly choose equity mutual funds over debt or hybrid funds, right? It depends on everybody's age, but let's say you're starting in your 20s, you're in early 20s or even early 30s for that matter, right? I would suggest most of your investment should be in pure equity mutual funds, which means a flexi cap fund or an ELSS or a multi cap fund, or it could be a mid cap fund or small cap fund to a certain extent, some small allocation to small cap funds. Once you kind of cross 40, you might want to diversify in terms of adding a hybrid fund or maybe taking exposure to debt. But in your 20s and 30s, most of your investment should be predominantly in equity mutual funds, pure equity mutual funds, and it should not be touched. Just invest it and forget about it. Make your all your due diligence, make all your research about the fund or a mutual fund scheme before investing. But once you are sure that it's a good mutual fund, just put your money in through a SIP and forget about it. Don't keep looking at your portfolio, because that is where you get the itch to kind of redeem it, if there are decent enough returns, right? The next point is that you need to invest more today to get more money tomorrow. See, you can't invest a 500 rupees SIP today and expect that you will suddenly get a crore of corpus, maybe 10 years down the line or 20 years down the line. That is not going to happen, right? So if you want a really good amount, maybe 10 years or 20 years from now, you have to do a backward calculation, and that is where a mutual fund advisor can help you in terms of what is your goal amount. Let's say you want to retire at 50, and the amount that you're looking for at when you reach 50, say 20 cr. Now, if that 20 CR is your goal, what is the monthly SIP that you need to do? That is what a mutual fund advisor can help you determine, and that is where the mutual fund advisor can also help you suggest the good schemes for you that would help you achieve that goal. Now, I am also a mutual fund advisor. You can contact me at the end of this video. You will see the my contact details. You can contact me. We can have a chat. We can understand your investment goals. I can suggest the right schemes for you to achieve whatever financial goals that you have. Finally, now this advice is coming from Peter Lynch, the most successful actively managed mutual fund manager in the history of investing, right? So take this very seriously. This is somebody who has played the game, who has excelled the game at the game of investing, at the game of fund management, mutual fund management at the highest levels. There is no better mutual fund manager than him in the world today, at least today, and I doubt if anybody else would give those kind of returns, right? So read this very carefully, okay? What he is saying is that reviewing the past performance of funds is a waste of time. Some people buy last year's biggest winner. This is particularly foolish. The 1 year winner tends to be a success story because of a bet on a particular sector or industry or a stock. Next year, this fund could be at the bottom of the list, right? So, picking future winners from past performance does not seem to work even when you use a 3 or 5 year record. A lot of us, what we do is that we go these days. You have all these apps, right? So you just go to the app and the app shows these are the top three best performing funds over the last 1 year, 3 year, 5 year, and then you just pick the fund which has given maybe the best return over the last 3 years. What Peter Lynch is saying is that it is not the right way to choose the right mutual fund, right? Then what is the right way? Yes, we'll come to that. His second point is that that is not to say you should not pick a fund with a good long term record, but it's better to stick with a steady and consistent performer than to move in and out of funds trying to catch the waves. Very, very important advice. A lot of the mutual fund investors, what they do is that they will pick a mutual fund scheme, then they will keep comparing the mutual fund scheme returns to other schemes in the same category, right? And then they will see uh, some other scheme in the same category is performing better than their scheme, so they will suddenly redeem these units and reinvest it in the other scheme. Now tell me what happens if the other scheme after a year starts performing badly. Then what will you do? You will again redeem those units and put it in some other scheme which is at number one or number two, right? So this kind of redemptions, reinvestments into other schemes, they completely destroy your returns. Not to mention, if you redeem units within 1 year, there is an exit load of 1%, which is charged by most mutual fund schemes. Then there is this short-term capital gain tax in India that you redeem your certain mutual fund schemes, before completing 365 days. Those gains are taxed at 20%. But if you wait for a year or more, those gains are taxed at 12.5% plus obviously the cess and all, right? So this is tax inefficient and it completely destroys your value creation opportunities. So what does he say? Also look at what happens to funds in a bear market. So there are three scenarios when you're looking at a fund and what happens in a bear market. Okay, now that funds lose more than others, quite possible, but they also gain more on the rebound. What does it mean? That when the market declines, the fund will decline more than the market or even more than the other category peers. But when the market recovers, it will gain more than the market and its category peers. That is okay. Second, some lose less but gain less. Now, these are typically funds which have a very conservative investment strategy. What happens is that when the market drops by maybe 10%, the fund will not drop by 10%, right? The fund will probably give you a return of maybe minus 8%, minus 7%. But when the market recovers, maybe the market bounces by 10%, at the same time, the fund will also not bounce more than 10% or even 10%. It will probably bounce 6%, 7%, which means the fund has a low volatility, right? And the third possibility when you are evaluating a fund during bear market is that the fund loses more but gains less. Now, this is the kind of fund that you must avoid at all costs. So this is Peter Lynch's advice. He is not telling you what are the right funds to choose, but rather he is telling you what are the funds that you should avoid. Funds that lose more during the bear market and gain less when the market goes up are the kind of funds or schemes that you should completely avoid, right? So what this means for mutual fund investors? Okay, so do your homework about a scheme before investing in it, right? Don't just look at past returns. Understand the fund's category, investment framework, risk ratios, and volatility of returns, right? All this information is freely available. You don't need any subscription to any software or that kind of thing. I will tell you where you can get this information in later slides. There are multiple these days online websites available where you will get these returns, right? Another important point is that if a scheme is consistently outperforming its benchmark, it's a good scheme or a good fund irrespective of its ranking among peers. This is very important, and the so-called expert mutual fund investors or sophisticated mutual fund investors, they keep comparing that, right? So when it comes to flexi cap funds, there are probably 30, 40 different flexi cap funds from various mutual fund categories, and every year there will be some new story. Not every year these days, to every month there are stories that flexicap in flexicap category this particular fund has returned uh, maybe 10%, while its peers return maybe 5%, 4%. So it is a top performer. Look at your fund manager's performance over say 3 to 5 years and see whether the fund has beaten its benchmark. Every fund has a benchmark. There are two types of benchmarks. One is the primary benchmark, and the other one is the additional benchmark. Right? Look at if the fund has outperformed its primary benchmark. If that is the case, over say consistently, means over a 3 to 5 year period, you should see that it has consistently outperformed its benchmark. It is a good fund. Do not switch out. Do not redeem the units of that fund to invest some other top firm in the same category. Right? So this is what I was talking about. Where do you find this, mutual fund performance information, whether the fund has outperformed its benchmark or not? So one source is moneycontrol.com. This is a website wherein you can go in, search for your whichever mutual fund you want to invest in, look at its historical returns. So this is the data which I have for Parag Parikh FlexiCap fund. If you have seen my FlexiCap fund video, you will know it is one of the best funds in the market right now. Not the top, but definitely very good in terms of consistency of returns. Now look at this fund's performance or returns. These are returns. Okay, so the fund's returns are shown in blue line, while its benchmark, right, which is Nifty 500 TRI, is shown in orange line. Now look at its performance. So I have taken a 5 year period. The fund has returned 22.6% annualized return versus the benchmark return of 20.72%. So it has easily beaten its benchmark by around say 2% or 200 basis points. And if you look at the graph, it is consistently above, right? So from around say June 23, right? It has the blue line is consistently above the orange line. And even in the past, at there were periods where it was below the orange line. But see, over 3 year period, 2 or 3 year period, if a fund has consistently beaten its benchmark, it is a good fund. Do not think about switching to some other fund in the same category. If I were to put some other funds in the same category, this fund has given 22.6%. Maybe there are other funds which have given 24%. There are some funds in flexicap category which have probably given even 30% returns in the same period. But if you have invested in this fund for the last 5 years, you have already compounded your returns, right? If you suddenly redeem units from this fund and switch to some other top performing fund, first of all, you're losing the compounding benefit. You understand? I mean, compounding is a different topic, but understand this is like a in a fixed deposit when you it's like a recurring deposit, right? So you put a principal amount, then periodically there are interest payments. Now those interest payments are also added to the principal, and then the next interest that you get is on the higher amount, which is the principal plus the last interest. So similarly, the compounding is going on. And I'm not saying this only about this scheme, right? There could be some other scheme in some other category. If a fund has consistently beaten its benchmark, it is a good fund. To not unnecessarily redeem the units and reinvest in some other scheme because that particular scheme has given maybe 2 or 3% extra returns. What happens if that scheme suddenly starts performing after a couple of years? Then what are you going to do? Again redeem those units and reinvest in some other fund? No. Right? So these are some basic informations about, or the basic advice about investments in mutual funds. Understand that mutual fund investments is all about patience, all about having long term orientation, and all about having discipline. Do not stop your sips when the markets are down. Do not discontinue with your investments or start redeeming them when the markets are down. You have to be patient. If you have done your homework, if you have done all the returns analysis, the understood the funds investment framework, and you are sure that you invested in a good scheme, just let the market and the fund manager take care of this short term volatilities. Whatever advice that you saw in the previous slides were from these two books by Peter Lynch, One Up on Wall Street and Beating the Street, and this article which has summarized the key learnings from these two books. These are the sources for the information which was presented in the previous slides. If you are a first time mutual fund investor, I want to give you the good news that investing in mutual funds is a fully online process. There are no Xerox copies, no physical forms, no passport photos to be submitted. All you need is your Aadhaar card number, PAN card number, and a cancel check photo. How do you now invest in mutual funds? You scan the QR code on the right using your phone camera or any other app. It will take you to your phone's app store. You download the Funds Bazaar app, or you click on the link given in the video description, and you go to the website, Funds Bazaar website, and over there you enter your name, email ID, mobile phone number. You get two OTPs, one on your email, one on your phone. You enter those OTPs so that your email and phone number is verified. Once you are registered on the app or on the website, you start the KYC process. You enter your Aadhaar number, PAN card number, and upload your cancel check photo, and done. Your KYC is done. You are free to invest in any mutual fund scheme. This app has all the mutual fund schemes that are available in the market. They are available on this app also, or on this website also. In this entire process, if you face any difficulties, or if you have any queries about investments in mutual funds, or what kind of schemes are right for you, where should you invest, what should be your investment horizon, etc., you can contact me on this WhatsApp number 9757309269. I would be happy to help you. I'm an NISM certified and AMFI registered mutual fund distributor and advisor. I wish you the best and a prosperous investment journey. Thank you for watching this video, and keep following this channel for more informative videos on the mutual fund industry. Thank you.